Good morning. So today let us discuss what is meant by liquidation and why the companies will move into the liquidation. So we all know that liquidation is nothing but the closing down of the business, or it is also known as winding up of the business. So what is the winding up of a company? See here, the company can be created only by the law, and the law only can dissolve it. It has no natural death. So there is no natural death like a human being because company is an artificial person. It is created by law and it is also be cremated by law only. Other than law, no is one is empowered to dissolve the company. So under this company, we already discussed the company is nothing but an artificial person created by law and dissolved by only by the law. So liquidation is nothing but a closing down of the business or shutting down of the business. Why the company should liquidate? Whenever the company is having more liabilities than assets and the company was unable to repay the debts, so automatically that company may go for liquidation. And sometimes even the company is solvent, even though the company may go into the liquidation in some cases. Why? Because it's due to government policies. Today we are producing one product in India and you are dealing with that product and the government policy has been changed. The company wants to detain you not to produce such product. It has been strictly prohibited. So when the government has changed the policy and you are restricted not to produce the product, then you have to wind up your organization. It is a mandate. So under winding up, there are two types. One is compulsory winding up by tribunal. I think you know what is meant by tribunal, nothing but a court, whether it is a high court or a supreme court. Compulsory winding up by tribunal, and another one is voluntary winding up. What is compulsory winding up by tribunal? So under the following cases, a company can be liquidated by law, by the court. So that is called a tribunal. For example, when your company is unable to repay the debts, you are unable to repay the debts of your company. Company is having a lot of liabilities. When you holds an ample of liabilities and you are not afford to repay those liabilities, the debts, automatically the company can be liquidated by the tribunal, by the court. And another case is if the company was failed to prepare its financial statements. We all know that it is very mandatory as per time period concept. In some jurisdictions, every organization has to prepare the final accounts. That means financial statements. If your company do not prepare the financial statements for the consecutively 5 years, then automatically the court will suckle into your company's affair and the company will be wind up. Why? Because you are not disclosing your company results to the stakeholders continuously for 5 years. Then automatically you are not empowered to continue the business. Your company will be wind up. Your name of the company will be struck off from the registrar by the registrar from the register of the companies. And another one is when your company has been launched for a specific period, some stipulation period. So you are empowered to continue your business only up to the extent of that period only. For example, you started a company for 5 years, for a period of 5 years. You are allowed only for the 5 years period. This is the stipulation period to continue your company. In case, if your company is not empowered to go beyond this 5 years, then also the court can suckle into your company affairs. Your company can be liquidated by the court. Why? Because you are given a specific period. After the expiry of this stipulation period, you are not entitled to continue your organization. Sometimes, and another case is, you can dissolve your company through the court by passing a special resolution. whenever you started the company and if you not started your activities within the 1 year of incorporated as a company, when you are incorporated as a company, you have to start your activities. If you are not started your activities and if you are completely refrained for 1 year without making any activity, then also you can also court can liquidate your company. So this is also one of the case. So these are all called as compulsory winding up. It is a mandatory. The court will settle and the court will ask you not to continue your organization, not to do any activities. Your company has been dissolved. So that is called as compulsory winding up. What is another one? Voluntary winding up. There are two types of voluntary winding up. Already we discussed in the earlier class also. Members winding up and creditors winding up. What is the members winding? Who are the members of the company? Shareholders, contributors. So when these shareholders, if they don't want to continue the organization, after convey the meeting, if they take the majority of the shareholders view into consideration, if the majority of the shareholders has not confessed to continue the organization, so they can just pass a resolution, and that resolution has been sent to the court, and they can get an approval from the honorable court. After refusing the court for resolution, the court will give the order of dissolution. This is called members. Members is nothing but owners or contributors or the shareholders who are not interested to continue the organization. The majority of the shareholders has consented to nullify the company, so they are empowered to just pass a normal resolution, and it has been submitted to the court. And what is the creditors? Another one. So we discussed in some units. Creditors means a person who lends the loans to your organization, either a banker or a financial institutions or a debenture holders or any public. So when you borrow the loans and when your company is not afford to pay even the interest to these creditors, and they will automatically get a suspension on your company that you are unable to repay their principal amount. So these persons can file a suit against your company and they can ask the court to dissolve your organization. Then automatically the court will dissolve with the appeal of these all unsecured creditors or the secured creditors, whoever it may be. So this is also known as a voluntary winding up of company. But there is a slight difference between insolvency and company or liquidation. Insolvency applies for individuals or partnerships or HUF, Hindu undivided family. If you are having more liabilities than your asset, your solvency position is very bad, and you are facing a lot of financial grieving, and you are not able to continue the business. Either you are an individual or a sole trader or a partnership or Hindu undivided family, then these all comes under the Insolvency Act. So insolvency applies to these individuals, partnership and HUF, and Insolvency Act will apply there. But whereas coming to the companies, Insolvency Act does not apply. Liquidation Act applies to the companies. Why? Because once the company is liquidated, wind up, or it has been rescinded, you are not empowered. Once the decision has given by the court to liquidate your company, you are not entitled to continue the business on the same company name, but not like in the insolvency. When you became an insolvent, after getting a discharge of all your debts, you can continue the business. But in liquidation, it is not like that. Once the company has been liquidated, it is not at all empowered to continue the business on the same name. So automatically here, when your company went into the liquidation, your directors or your CEO, chief executive officer, or your officers, any officers, they should prepare a statement of affairs. What they have to prepare? Statement of affairs within 21 days after going into liquidation. So you have to prepare the statement of affairs. So this statement of affairs is prepared by who? By the company directors, or it can be prepared by the CEO or any officer of the company. These people only will prepare the statement of affairs. What is the statement of affairs? It gives the details of your assets and liabilities. So it will be prepared from list A to list H. Let's know this statement of affairs has to be prepared within how many days after liquidation? 21 days. What are those statement of affairs? Number one, list A. Assets not pledged. It means your assets has not been mortgaged to get a loans from any banker or a financial institution or unsecured creditors. Assets which are not specially pledged, that is called list A. And list B, it is known as assets specially pledged. So here your assets having a lien right. You are giving you are mortgaging your assets to the creditors. They are known as a secured creditor. There may be a partly secured, there may be a fully secured. What is meant by fully secured? When your loan value is less and you are given more security than your loan borrowed, that is called a fully secured creditor. When you are given a less security and the loan is more, that is called a partly secured creditor. So this assets having a charge on your assets to this secured and partly or fully secured creditors. They are empowered. You are not entitled to sell those assets unless you pay that obligation, discharge the obligation of those secured creditors. List C, preferential creditors. I already told you preferential creditors means who are having a priority in making the payments, like government taxes due to the government, or any amount salaries due to the employees, or wages due to the workers, or rent due to the landlords, outstanding rent. So these are all called as preferential creditors. So under the Liquidation Act, there is some limit. Up to what extent you can consider that payable amounts as a preferential creditors. It also depends upon a towns, whether it is a presidential town, the rule will be different, and it is a provincial town, the rule will be different. I think what is the presidential town is nothing but Mumbai, Kolkata, Delhi, Chennai. These are all comes under the presidency towns. And other than these cities, the remaining cities comes under the Provincial Act. So the preferential creditors has to be decided basing upon the Liquidation Act and basing upon the town, presidency town and provincial town. And next come to the list D. List D is nothing but unsecured creditors. What is meant by the name itself is implied, unsecured. You are not given any security. Just you borrow the loan and no charge is there to these creditors on any asset of the company. No asset has been mortgaged to in the hands of these unsecured creditors. Those are called as unsecured. No security is there. Only the solvency only is the security to these creditors. Your company solvency. That is only the security for the unsecured creditors. Other than that, no assets will be given as security. And list E, debenture holders. What is meant by debenture holders? I already explained in the shares. Debenture holder is nothing but a lender of the company who lends the loans for a specific period, more than 1 year or 5 years or 6 years, like that. These people will get a fixed rate of interest until their money is repaid or redeemed. They are not the real owners of the company. Why? Because the shareholders are the real owners. They will organize the company. We all know that the directors are nothing but they are also one of the shareholders who qualified to contest in the directors' pay. And these people will be elected by the majority of the shareholders. And these people will run the organization. Why it is not possible for all the shareholders to come and squat in the company's office to organize? Because the shareholders are spread over all over India or all over the world. That's why a few people will be elected as the directors to administrate the company. Those are known as the directors. But even though they are empowered to run the organization, but they cannot make any decision without consulting the majority of the shareholders. Even if they want to declare the dividend, they have to convey the meeting of the shareholders. If the majority of the shareholders has consented, then only the decision will come into the force. Until that decisions will be there, will be intact, it will not be come into the force unless the majority of the shareholder has agreed. So debenture holders is nothing but they are the lenders, just like a long-term creditors to the company. And these debenture holders also has to be redeemed after the expiry of the stipulation period. Debenture is nothing but an acknowledgement of a debt which is borrowed by the company from the debentures holders at a fixed period for a fixed rate of interest. So they are called as the debenture holders, list E. And coming to the next one, list F. List F is nothing but preference shareholders. There are only two types of shares. In erstwhile, there are three types of shares: preference shares, equity shares, deferred shares. Now the deferred shares has been nullified after the Indian Companies Act of New Act of 2013. In the erstwhile Act 1956, the deferred shares are there. Deferred shares are the shares which are given to the promoters of the company at free of cost. So those has been manipulated and misleading the stakeholders. That's why the Companies Act 2013 has nullified the deferred shares. Now there is only two types. One is preference and another one is equity. Who are these preference shareholders? Who have the priority in paying their dividend, not only the payment of dividend, but also in repaying their principal amount. After paying and settling to the preference shareholders, then only the next successive shareholders is ordinary shareholders. That is known as equity. These are the real owners of the company. Without disbursement or without settlement to the preference shareholders, you cannot settle the money to the equity shareholders. So after settling the equity shareholders, but you have no sufficient balance, there is insufficient balance in the hand, then finally the list is called list H. This is called deficiency. What is meant by deficiency? Not a surplus. Deficient. Surplus means you have a lot of funds. You can pay the debts of the outsiders. But where is the deficiency is nothing but where the company is not having a sufficient money in his hand to disburse the payments of the secured or unsecured or any person of the company. So this is called a list H. This statement of affairs is one of the most important. It is not prepared by the liquidator. It is prepared by the directors or the officer of the company or the CEO of the company within 21 days after getting a winding up order or a verdict given by the honorable court or a tribunal. So this is the statement of affairs. And this statement of affairs is prepared by whom? By the directors or by the directors or the company officers, not by the liquidator. Next, the court, after getting the statement of affairs, this statement of affairs will be handed over to the liquidator. All the assets of the company and all the liabilities will be handed over to the liquidator. Who is the liquidator? Liquidator is an officer appointed by the court to assess the assets and the liabilities of liquidated company. When your company is rescinded, liquidated, liquidator will come into the force and the liquidator will hand over all your assets and he will disburse your company's liabilities. So liquidator's final statement. So the liquidator will prepare only the final statement, not the statement of affairs. Why the statement of affairs is not prepared by the liquidator? Because he doesn't aware about your company's assets and liabilities. When he doesn't perceive about your assets and liabilities, how could a liquidator will prepare a final statement? How could he realize the assets? How could he disburse the payments? So this is the most important. The statement of affairs. After that, the liquidator will come into the force, and this liquidator is an officer appointed by the court. So the liquidator has to prepare what? Final statement of account. This is final statement of account is nothing like receipts and payments. For example, I am the liquidator appointed by the court. I came to your company. I took your company's statement of affairs. Now I started to sell away all the assets of the company in the market. So first I have to realize the assets. So when I am realizing the assets in the market, what is coming into the business? Cash. What the cash has been accumulated or amassed, whatever the amount has been accumulated or amassed from the through the realization of the asset, so that will be in the hand of the liquidator. And not only the assets realized, if there is any calls in arrears, I think you know what is meant by calls in arrears. Those shareholders, even the company has called up, but they didn't pay any call money, that is called calls in arrears. Liquidator will issue the notice to all the people who haven't cleared the arrears. So he will collect the calls in arrears from the shareholders. So that is also some of the amount will come into the hands of the liquidator. So after getting these funds into the hands of the liquidator, then the liquidator will start the making the disbursement. How does he make the disbursement? Number one, first he will give the priority to fully secured creditors. First priority is given to whom? Fully secured creditors. Where the loan value is less and security is more. For example, if I borrowed a loan of 10 lakhs and I mortgaged a machine of my company worth of 20 lakhs in the hands of this creditor, here the loan is 10 lakhs and security is 20 lakhs. This is called fully secured creditor. Even the liquidator do not pay this amount. When the liquidator doesn't make the payment to the secured creditor, fully secured creditors, they will disburse your asset in the market and they will take their amount, they recover their amount, and the remaining surplus will be handed over to the liquidator. That's why the first priority will be given for fully secured. And next one will be given to partly secured creditors. Who are these partly secured creditors? Those who have given a less security than the loan value. Here the loan is more and security is less. For example, today I took a loan of 5 lakhs from the banker. And I given a security of my land worth of 3 lakhs. The loan value is 5 lakhs. And the given security, land value is 3 lakhs. Loan is more than the given security, 3 lakhs. So automatically this is called partly secured creditors. For example, if you have some 10 lakhs in your hand, now I pay fully secured creditors 2 lakhs, partly secured creditors 1 lakh. Out of 10 lakhs, I disburse so far 3 lakhs. Still I have how much money in my hand? 7 lakhs. The third priority will be given for liquidators remuneration. What is meant by liquidators remuneration? Whenever the liquidator is rendering the service to the company, this liquidator is entitled to get a remuneration from the company. Liquidator will get, say, 3 types of commissions. On assets realized, it depends upon the agreement. On the payment made to the unsecured creditors, on the amount disbursed to the contributors. Whereas on assets realized, there will be no problem. On assets realized, if it is a 5%, assets realized into 5 by 100. On amount payable to the contributors, that is shareholders, amount paid to shareholders into, for example, 2%, 2 by 100. But coming to the unsecured creditors, when I am entitled to get a commission on unsecured creditors, I have to check whether there is a sufficient balance to pay the unsecured creditors or not. If there is a sufficient balance to make a payment to the unsecured creditors, so I have to make a commission before charging. That means before charging means unsecured creditors into, for example, 3%, 3 by 100. If there is a sufficient balance in my hand to pay the unsecured creditor. If there is no insufficient balance, then the commission is calculated to the liquidator after charging. That is 3 divided by 100 plus 3, percentage plus 3, commission. 3 by 103. If it is a 5%, 5 by 105. If it is a 10%, after charging means 10 by 110. When balance is not sufficient to pay the unsecured creditors. In the same way, liquidator also will spend some expenditure. That is called a liquidation expense or cost of liquidation or legal expenses. So that is also will comes under the liquidator remuneration, cost of liquidation expense. So after making these payments, the next priority will be given for debenture holders. For example, commission is 50,000. Now you will call the debenture holders. You have a debentures of 2 lakhs. These debenture holders has to be settled, including their interest if there is any not paid by the company. That is called outstanding interest or interest payable on debenture holders. For example, debenture holder is 2 lakhs is there, and interest outstanding, which has not been so far paid by the company to the debenture holders. If there is a 50,000 outstanding, so therefore 2 lakhs plus 50, you have to pay 2 lakhs 50,000 to the debenture holders. Now what is your money? 10 lakhs. Out of that, so far you paid 2 plus 1, 3. 3 plus 50,000, 350. 350 plus 250, 6 lakhs. Still how much is there in your hand? 4 lakhs. Now you will call the preferential creditors. I already given a definition regarding preferential creditors. Preferential creditors is different from preferential shareholders. Both are not same. Preferential creditors means the creditors who have a priority. After paying or disbursing to the preferential shareholders, then you have to settle the accounts of the unsecured creditors. Without settling the preferential creditors, you cannot settle the payment to the unsecured creditors. I already told you. Any taxes due to the government, any rents due to your landlord, if you are running your company in a rented premises, or any salaries due to employees or wages to the workers, these all comes under the preferential creditors. For example, let's assume there is a 1 lakh preferential creditors. Next, you will call the unsecured creditors. Who are these unsecured creditors? No security. Just they lend the loan to our company without taking any security. No charge on any asset of the company. Only the solvency of the company itself is a security to these unsecured creditors. So, for example, if there is unsecured creditors of 1 lakh rupees, already you paid up to debenture holders 6 lakhs. Preferential creditors 1, 7. Unsecured creditors 1, 8 lakhs. 10 minus 8, how much? Still how much amount is left in the liquidator hand? 2 lakhs. Now you will call the shareholders. Out of the shareholders, first you will call who? Preference shareholders. There is a preference share capital of 1 lakh and equity share capital of 2 lakhs. This is the preference. This is the equity. I already told you. First priority will be given to the preference shareholders. After disbursing and settling to the preference shareholders, then you will call invite the real owners, that is the equity shareholders or ordinary shareholders. For example, there is a preference share capital of 1 lakh. Not only the preference share capital, their principal amount, if there is any dividend, if there is any arrears of dividend to the preference shareholders, that is also to be finalized, that is also to be settled. Without settling the dividend arrears and without settling their principal amount, you cannot go for the successive call or a succeeding payment to the equity shareholders. So after making the preference shareholders, then you will call the real owners. So eventually you are calling the equity shareholders. You will summon them and you will call them and you will say that only the 1 lakh is left in the hands of the liquidator, but there is a 2 lakhs worth of equity share capital. Is it surplus or deficiency? Deficiency. Company cannot settle the full amount of the equity shareholders because that much amount is not existed in the hands of the liquidator. You are having an equity share capital of 2 lakhs, but you are having an amount of only 1 lakh in your hand. How could you pay 2 lakhs to the equity shareholders? How could the liquidator cannot pay from his own pockets? If there is any surplus, he will pay to from the company itself. If there is no balance, sufficient balance, whatever the balance is existed in the liquidator hand, that will be paid to the equity shareholders. That means you are paying only 1 lakh instead of 2 lakh. That means liquidator is getting only 50 paise in a rupee. That is 1 lakh divided by 2 lakhs. Actual payment to be paid is 1 lakh, but actual payment is 2 lakhs, but you paid only 1 lakh. How much you paid? 50 paise in a rupee. This is called a deficiency. You are not having a financial ability or afford to pay full amount to the equity shareholders. Why? Because the liquidator cannot pay from his own hands or from his own pocket. The liquidator has to pay only from the company's assets realized or the cash left in the company or any calls in arrears collected. Other than this, the company or the court won't insist or won't, liquidator will not be coercion to make the full payment. In case, if in the liquidator hand there is a 4 lakhs rupees, up to making a payment up to preferential creditors, still there is a 4 lakhs. But there is only equity shareholders of 2 lakhs rupees. Now you can pay full payment to the equity shareholders also. Why? Because you are having 2 lakhs worth of equity share capital, but liquidator hand, in liquidator hand there is an amount of 4 lakhs. Now you can make a full payment to equity shareholders also. After making a full payment, still there is a 2 lakh surplus in the hands of the liquidator. Who share this surplus? Who will enjoy this surplus which is left in the hands of the liquidator? If there is no any special arrangement, special agreement, or any thing has been distinctly written in the Articles of Association, AOA, then the surplus is enjoyed by the equity shareholders only. And the deficiency or the surplus ultimately will be enjoyed by equity shareholder. If there is a deficiency, they have to borrow. If there is a surplus, they will enjoy. Sometimes preference shareholders also will given a priority to enjoy the surplus of the company. Then this surplus 2 lakhs left in the hand of liquidator, the 2 lakhs worth of surplus has to be shared between equity shareholders and preference shareholders. How do you distribute? How do we distribute this surplus between the preference and equity shareholders? You have to see in AOA up to what extent the preference shareholders have the priority. For example, if the preference shareholders have a priority up to the extent of 10%, out of this 2 lakhs, 10% means 20,000. Up to 20,000 will be given to the preference shareholders. The remaining surplus will be enjoyed by the equity shareholders. If no distinct percentage is given, there is no any distinct agreement between the company and preference shareholders in enjoying the surplus. But one clause has been written in the article AOA that preference shareholders also has the priority, but up to what extent the priority is not mentioned there. So then you have to go for capital ratio. You have to distribute both to the equity and the preference shareholders in shares ratio. The share capital of preference share is 1 lakh. and the share capital of equity shareholder is 2 lakhs. 1 lakh is to 2 lakhs, the ratio is 1:2. So preference shareholders having a priority up to 1/3. 1/3 surplus will be distributed to preference shareholders, and the remaining 2/3 surplus will be given to the equity shareholders. So this is the way of the preparing financial statement or final liquidator final statement of account by the liquidator after realizing the company's assets, after taking all the cash into the hands of the liquidator, and he will make the payments, disbursement. So this is what, whether it is a compulsory liquidation or voluntary liquidation, liquidator have to follow this final statement of account. But here I told you that you have to remember the statement of affairs is prepared by not by the liquidator, that is prepared by the director or by the company CEO or by any officer of the company. After getting that statement of affairs into his hand, then the liquidator will start his work, making of disbursement and realizing of the assets in the market. I think you understood about this liquidation. So tomorrow we can see how to do the problems under the liquidation chapter. Okay, thank you very much.